Hey everyone, welcome to another episode of Mayhem in the Markets, brought to you Saturday, April 15th by macrovisor.com, where we make macro easier and actionable. The first chart we have on screen talks about the level of financial stress that we've seen during prior episodes and today. The level today is 1.6, which brings us back to what we saw during the dot-com bubble burst and long-term capital management's collapse. This is the highest level we've seen since the COVID crash. So it's noteworthy, and it's certainly going to have an impact on other parts of the market. In particular, it's scaring banks. We can see that the stress in commercial loans and overall within the banking system is increasing. We have commercial real estate activity pulling back. We have banks slowing down on their participation in lending and lending less at higher rates, also trying not to take on as much risk as they had previously. And this starts to become a bit of an issue because when lending standards get this tight, we never see anything other than a recession. Let's just get it out of the way. It's very likely that that's what's coming. We can see during prior episodes where that dotted line is, where we are now, every single time led to a recession. And that's because we're in a credit-driven economy. And in a credit-driven economy, when there's less availability of capital and the capital that's available is more expensive, that slows growth, eventually to negative growth rates. And we can see that, even though many people are calling for this Fed cut, this Fed pivot, and look, the idea of a Fed pivot sounds good on paper, but the reality is it doesn't necessarily work so well for the market because when they're cutting, it's typically during a pretty difficult time. That monetary policy takes some time to work its way into the markets and even more time into the economy. So typically, the bottom from a Fed cut is actually quite a bit in the future. And this chart shows us that those first Fed cuts actually tend to lead towards bear market lows later on, right? Anywhere between 2 months and 20 months. But we know that that cut doesn't mark the bottom in a lot of these scenarios. And indicators that confirm bear market lows, the curve steepening, which we've seen. That's something that's happened as the 10s and 2s were at the deepest 110 bips negative, and now 58 bips negative. So we've seen that inversion come off almost by half. So there's that steepening. We've just talked about the credit tightening that is happening within the banking system. Now we're talking about the length of time from that first Fed cut to the bottom of the bear market. This chart suggests the average time period's about 10 or 11 months. So we are in the period of time now where credit tightens. That also suggests that we're some months away from the first Fed cut. So we could say we're probably more than a year out from the average bear market low, where this chart suggests we would be if we're on any similar trajectory that this market has seen for over 100 years. Now, obviously, past is not prologue, so it doesn't necessarily need to follow these rules, but by and large, it makes sense, right? The curve steepens. That's a sign the bond market's starting to lose some degree of confidence. It pulls the probability of a recession's timeline forward. Credit tightens. That slows down a debt-driven economy. That leads us into a recessionary environment. And then finally, the Fed cuts, and eventually the market bottoms, eventually earnings trough. And eventually the U rate, as referenced on this chart being the unemployment rate, peaks. And we can see that from that point, we really do make a bottom and start to move higher. So these are indicators to keep an eye on, maybe put on one's sort of bear market bottom checklist and take a screenshot of this chart, save it for later. But this is something that I think is worth keeping an eye on. Global house prices are falling. This shows that New Zealand's down 14% year over year, Sweden 13%, Australia 9%, the United Kingdom 3%, Canada's actually up 1%, the US is up 3%. But we're seeing what leads us down the path of a global recession because housing is such an important component And when people can't afford housing, it's also a sign that there's not going to be as much family formation. There's not going to be as much spending into that part of the economy. Real estate, housing, construction, all the services that go with it, they tend to take up about 15 to 18% of GDP. If that's all slowing down, what does that mean for the economy? It means it too is slowing down. After-tax wages and salaries growth based on the Bank of America aggregated consumer deposit data that they share is falling. In fact, after-tax wages and salaries growth is only up 2% year over year. So this is getting back into the range that the Fed wants to see. This is not the official data, so we still need to let this pass through. But it does suggest that consumers are also having a tougher time, because if this is just 2% year over year and inflation's, around 5% plus year over year, then that doesn't paint a pretty picture for the consumer, because they're still earning less than the prices are rising. They're earning salaries that are rising at 2% a year at this point. Prices are rising at around 5% a year. And that leads us to a path that causes some degree of concern about inflation. In fact, when we got the University of Michigan inflation expectations data looking 1 year forward, we saw that perked back up to 4.6%. People think that a year from now, inflation will be 4.6%. This is up from 3.6% the prior reading. So people's concerns about inflation are also rising while the growth rate of their wages are falling. And that leads us down the path of consumer sales slipping, which they did in March. And general merchandise was hit the hardest, down about 3% month over month. But just across the board, everything fell. Auto spending fell quite a bit as well. This is a consumer that's not confident. They're spending on what they need to. They're not spending on anything they can defer or don't need. And that's something that tends to portend towards a more recessionary environment in an economy where 2/3 of activity is typically driven by consumption. Of course, the fourth quarter of 2022 was an exception. The biggest driver of growth in the economy was inventory building. What's not going to happen with numbers like these? We're not going to see inventories built. Consumers are clearly not playing their role. The economy this quarter is likely to soften further. Atlanta Fed GDP now is suggesting around 2.2%, revised up from 1.5% after that stronger non-farm payrolls data. But it's really anyone's guess at this point. We're still getting some more data from that quarter. I think that we'll see some softness, maybe high ones, low twos for that quarter, and increasing softness as we get throughout the year towards a recessionary environment as we get towards the end of the year. Spontaneous mentions of high prices. I alluded to this a little bit earlier. This is from, as you can see, the University of Michigan. And what it's showing you is that personal finances, more and more people are concerned about high prices, which honestly, it makes a lot of sense because the rate of inflation has slowed. But a lot of prices have not come down. So that means people are still struggling with higher prices than they can afford. And so they're buying the same amount of necessary items, the staple items, but they're paying more for them. And that compresses their discretionary income to spend on things like buying merchandise, travel and leisure, going out to restaurants. It's likely that some of that froth we saw in January that rolled off in February is over. And that was from bonuses, gift cards, other kinds of credits that happen around the holiday season that aren't likely to be a durable phenomenon. And on the other side of it, we see that there's some growing pressure on the employment market. It's just in its early phases, but it'll probably start to pass through to mainstream payrolls, those non-farm numbers, in the next couple of readings. PC market. Well, let's look at this. This decline is huge across the board. Apple at 40.5%. But everyone declined on average just under 30% at 29%. This is an ugly reading because it really does suggest that the consumption cycle for consumer electronics and for other kinds of items that can be deferred, that's all being pushed off. A lot of it was also, quite frankly, pulled forward. And what do I mean? Well, when everyone got these PPP loans or COVID stimulus checks or other kinds of sort of helicopter money and artificial wealth effects, a lot of demand for goods was pulled forward by both companies and people. That cycle of pulling forward demand is over, and now we're in the hangover period where there's a much slower refresh rate of technology across the board. And I think this bleeds into other kinds of consumer discretionary spending. And I believe that this is something we're going to have to contend with for a little bit. We had a year and a half, 2 years of intense goods-driven spending. So one of the reasons inflation was what it was on the goods side. And that's starting to level off, which is good for inflation to slow it down, but it's certainly going to hurt the economy and earnings. And we can see multifamily building sales, or essentially apartments and condos, they are falling. This is the lowest levels we've really seen since the COVID crash. And this is a pretty steep drop. I think it does suggest some of the weakness that we're seeing in commercial real estate. And when we zoom out, this commercial real estate transaction volume chart shows a very similar picture, where the levels of transactional activity are similarly just about as low, or we haven't seen this amount of low activity since that COVID crash period. So this brings us back also before that to what we had seen just after the great financial crisis. That is to say, there is a lot less transactional activity here. And this is a problem because a lot of the smaller and regional banks were financing this activity. About 70% of the origination of commercial real estate loans were going through those same banks that are pulling back on lending, tightening their credit standards. This is something we just looked at in some of those earlier charts. And so what does that suggest? It suggests that there's going to be some more difficulty for the entire commercial real estate sector, but particularly multifamily buildings, offices, warehouse, and retail. And we can see that the consensus expected S&P 500 EPS growth is in an earnings recession. This is the second year-over-year quarter of that earnings recession. It tells us that we're likely to see more pressure on earnings as this earnings season really kicks off. And the week ahead is going to have a lot of really interesting earnings reports, so it's something we should be paying very close attention to as to what we can learn from various companies in different key sectors, their forecasts, what they tell us about what they've seen and what they see ahead. And while some people like to refer to earnings and economic data as backward looking, the reality is that this data can form trends, and those trends can have a big impact on price discovery, particularly over the intermediate term. So to ignore this supposedly backward-looking data is really to one's own peril. Plus, there's a lot to learn. We can learn about how these companies are faring in the economy. We can learn about whether or not there are some that have competitive advantages that might outperform, others that may be weaker, that could be candidates for raising cash if one has long exposure or potentially shorting or being parts of pair trades. There's always something to learn from everything. The market provides us, as students of the market, with unlimited opportunities. And that's one of the things that we do both at macrovisor.com and at traderaid.com. We teach. At Macrovisor, we make macro accessible and actionable. And at TraderAid, we talk about trading on short and intermediate term time frames. We talk about ideas, and we talk about how best to trade, how to learn how to be consistent. So at Macrovisor, we've got a 50% off sale. That means that if you sign up now before April 20th, you will get 50% off for your first year, whether you sign up for a monthly or yearly plan. And at TraderAid, we've got a 10-day free trial that you can check out on our base plan, our TraderAid monthly plan. Either way, we welcome you to check out these projects. We're trying to do something a little different where we focus on education, actionable information, and community building, because we want to create environments where people of all skill levels and backgrounds can get together and benefit and learn and find the signal within the noise so that they can sharpen their edge in trading and investing. The next chart we have is U.S. share buyback authorization announcements through April 6th, year to date in 2023. These are the highest levels ever. And this is a pretty interesting situation when you compare and contrast it with what's happening in some of these companies' earnings. Some of the same companies that aren't having those really great earnings numbers are also increasing their buybacks. Interesting dichotomy, to say the least. And then, of course, when we look at some of the adjusted EPS or liar's EPS, we can sometimes see those companies net out things like buybacks or stock-based compensation or otherwise. So I would just be very skeptical of companies that are boosting their stock price with buybacks too much if they don't have a lot of cash. If they have cash and that's what they're using for their buybacks, that's not as big of a deal. I'm not a huge fan of it if they have opportunity to create a moat through better capex on research and development, but I can at least respect that they have the cash to deploy. The companies that are using debt to do buybacks, if any are still foolish enough to do that, that is a danger sign because of the cost of capital these days. So just my 2 cents. And look at this. Look at the buybacks in gold. Isn't this extraordinary? From really 2007 on, the amount of buybacks have grown and the amount of capex has shrank. So it tells you a story of companies that are doing more to buy back their own shares and less to really reinvest in their own companies. And I think that's a little bit of a concern. Remember, it was only until really, I think it was the 1980s, under the sort of great deregulation of Reagan, that buybacks, once illegal, because they were thought to be an agent of manipulating stocks, were made legal again. And now we're kind of dealing with the aftermath of that phenomenon. So you can see how much buybacks have increased even since the 90s here on this chart. But this is something that I think is going to be a bit of an issue. Buybacks have also driven a lot of returns, and I think that now that the age of easy money is sort of behind us, at least for the time being, this sort of activity will eventually slow down quite a bit, particularly as we start to see some deceleration in revenue and earnings, and companies have less cash to put into buybacks. We'll, of course, see what happens. Anything is possible, but that would be my take on this, because I'm just a little bit concerned that these companies aren't putting this cash to potentially better use. Investors are pulling money from U.S. equity funds while Europe and China gain. This is interesting. You can see it from really January of 2023. U.S. exposure has been falling. We've seen a rise in Chinese exposure, and up until recently, European exposure as well. We also know people are putting more money into treasuries, they're putting more money into money market accounts, they're diversifying their exposure because we're no longer in an environment of there is no alternative. We can get decent yields on fixed income and other yield generating opportunities, and so many people are, particularly those in older age groups that haven't had this opportunity for over a decade. And I know a lot of people are talking about how short the market is, right? How short hedge funds are and how short CTAs are. Look, I can say that it's certainly a situation that may limit downside, particularly if there's an upside catalyst that's big enough. On the other side, take a very close look at this chart here. What do you see on this chart? In the period before Jackson Hole, the market was rallying. Right, you can see that little July line 2022 on, and people were getting more and more short into that rally, right? And then what followed? We saw a big fall after Powell came out at Jackson Hole and said, we're going to cause pain. He scrapped his original speech. He gave an 8-minute fire and brimstone lecture about how the Fed really has to do their job to vanquish inflation. Everyone was really expecting a more dovish Fed at Jackson Hole, and he gave us the opposite because Powell doesn't feel the inflation threat is behind us, and he's right. And so what happened with that extreme short positioning? Well, they began to cover as the market began to fall. So all the folks that were extremely short into Jackson Hole made a lot of money, right? Look at this other one here during the bear market rally that happened in early 2022. Just after that January line on the bottom x-axis. You can see that people were getting more and more short into that rally, and then as it started to come off, they covered. These shorts are savvy. They do know what they're doing. Hedge funds are not always on the right side of the trade, but they're often on the right side of the trade. And if you do study this chart closely, you can see that in the near term, the market, when these shorts are piling in, tends to peak and roll over, and they tend to cover into that. There have been articles about this. What does the market do in 3 to 6 months? Oh, it's typically higher. I mean, you could, like 66% of the time, I think someone said it's typically higher in 3 to 6 months. What does that matter? Most of the time, the market's higher in 3 to 6 months, no matter what time period you look at. So that's like a totally irrelevant statistic given the short duration of this exposure on the short side, right? These guys are not short for very long periods of time. It's like maybe 1 or 2 or 3 months, right? So I would just caution the idea of looking at extreme short exposure in instruments like S&P, because it's not necessarily going to give you some kind of contrarian indicator that there's, a limit to the downside unless there's a positive catalyst. That's really going to be your best bet, right? You got to have something that makes the shorts cover. I mean, Silvergate stock was like 70% of its float was shorted before it died. It didn't have a giant squeeze. It literally died. Yes, there were events that led to that, but those events were sort of things that were writing on the wall. And that is to say, these guys that are running billions of dollars have some bearing, probably more than a lot of us retail folks do, on what's going on behind the scenes in the market. And when they get aggressively short, there are reasons for it. And typically, those reasons give them the ability to make some profit, right? They're not just putting this money at risk for no apparent reason at all. We also don't know what the other side of their books are. What are they hedging? They're probably not just 100% net short. They probably have a long book, and one of the reasons they're getting aggressively short is to hedge that long book against risk. So just keep all this in mind when looking at these charts, and they go viral on Twitter, and people start to draw these spurious conclusions from them, kind of thinking of them a little bit more two-dimensionally. But the reality is there's more variables at play, and another important one in the broader context of hedging is skew in the options market on the SPX index, which is the broadest, deepest options market in the entire world, where over $1 trillion of notional trades every single day in the SPX, and about half of that to expire in 6.5 hours or less. So that's another area, and when we see these extremes here, if we don't see skew very high, we're still not seeing a very well-hedged market overall. The futures exposure is significantly smaller than that options market. So that would be another thing to keep in mind. Yes, skew has risen. No, it's not very high. So I would just caution saying that they are extremely short, and I would rather say something like this is an unusually aggressive short position that in prior times has led to more downside in the market. These guys are often right. And we're talking short term, right? They're not taking these short positions, as you can see on the chart, for years at a time. They're not even taking them for half a year at a time. Most of the time, they're getting out of these things when the market turns the other way and covering and flattening up. So just kind of think about that when you see these charts out there, because it's just like the stuff with the de-dollarization. People start to draw conclusions off of a couple bits of information in isolation and oversimplify what the ramifications are in the timeline for it. And I would just be a little bit more cautious about taking that approach. On the other side of it, I think it's important for us to look at multiple different data points to get a more complete picture so that we can understand more of the mechanics that are moving price in the market. And speaking of mechanics that move price in the market, here are the assets of major central banks in the S&P 500. This is one of the reasons that I like to emphasize that macro does matter. There's been folks disparaging macro here and there, saying it doesn't matter, it makes you a worse trader, no one made money with macro. I would like to remind those folks of the existence of people like Jim Rogers or Stan Druckenmiller, who made tons of money on macro. People might not be a fan of Soros, but he also made a decent amount of money on macro. The point being that macro for intermediate term and sometimes even short-term trades, it does work, and particularly works on the longer time horizons. And this chart proves it unequivocally. We can see the positive correlation between the total assets of the Fed, European Central Bank, and the Bank of Japan, showing that aggregate liquidity among the three major central banks has a correlation with the performance of risk assets. As that liquidity perked up, particularly with the Bank of Japan, we saw stock markets stabilize and rally. And it's not a huge surprise. What will be interesting is how this starts to look as we get into a more difficult liquidity environment. Not seen on the chart is the People's Bank of China or the Treasury General account, which have also added liquidity into global markets. That Treasury General account is about spent. The People's Bank of China have not had a lot of luck stimulating the Chinese economy. There might be some more stimulus to come there, but I believe it'll be more directly targeted at their economy rather than permeating into global markets. And the Bank of Japan's new governor says he'll keep things status quo, but how much new liquidity they add in to control the yield curve on the bonds remains something to be seen. Maybe they'll expand the range a bit, maybe +1, -1% on the 10-year JGBs. Nevertheless, the Fed seems committed to continuing quantitative tightening. They did set up a new lending program called the super discount window. That was not QE. QE was the Fed buying assets like treasuries at auction and in open market, as well as mortgage-backed securities. This lending facility is for banks to come in and take illiquid assets that are government-backed like treasuries and agency mortgages, and they have to pay the Fed 4.5 to 4.75% on securities that are largely yielding 2, 3, maybe 4%. So there's a negative carry cost. It's punitive. It's not the same as QE. And I think we can see that equities agree, because if you put $300 billion of actual QE in the market, we should be at all-time highs at this point. We didn't see that, and I think it's been drastically misinterpreted by some folks who have tried to kind of conflate what the Fed did with QE. The reality is what the Fed did was actually so they could keep doing QT and keep rates higher for longer. They stabilized the banking system and provided some lending facilities so that they can continue trying to fight inflation. So I don't think it's a conspiracy. I don't think that the Fed is lying to us all. You can see their balance sheet is shrinking again when you look at their own website. And I think that at the end of the day, they've got a lot more work to do to try to shrink their balance sheet and to try to reduce the demand drivers of inflation. The irony is, of course, that the Fed is making the cost of capital more expensive for a lot of businesses, and that's going to limit supply-side elasticity as we get into the next economic cycle, and that'll be a whole other catalyst for structural inflation. The irony being that high rates actually create embedded inflationary pressure by destroying supply-side elasticity while they also destroy demand. Something we'll talk about a little bit more as I usher in the concept of entering an era of scarcity as we exit an era of abundance. And equities and recessions. This is a fun little chart, and it suggests to me that we do have some more downside to go in this particular bear market route, especially because the equity market's been so strong in the face of so many different headwinds. And I think that resilience will ultimately prove to be a bit of an issue for those who have been so adamant about buying every dip at valuations that, were this to be a new bull market, it would be the most expensive new bull market in history. And that's not where you want to be buying for the long term. A PE of 18 on the S&P before we've seen the earnings recession really take down EPS suggests that we're probably buying, if one is buying here, at a PE that will be later seen as over 20, right? The problem is with the PE, what's the E? Well, if the E goes lower, price has to go lower too. And that E, I mean, some of these calculations from FactSet are saying S&P earnings this quarter, year over year, are going to be down as much as 7%. So you have to start to look at what does that mean for metrics like PE. And if we do start to see earnings come down and we start to see valuations that are more similar to what they would be in a recession, that would be a PE of 15 adjusted to lower earnings that are maybe 10, 15% lower. That suggests the market has quite a bit of downside. 3,000 or lower is a likely downside target for the S&P before this is all over, unless something happens that causes the Fed to have to aggressively ease. And even if they do, whatever causes that is likely to be a pretty negative catalyst. So I would just be a little cautious of saying the bear market is over. I think the October bottom had a lot of liquidity-driven catalysts to push equities higher, and this is something I've been talking about since then, that we've had Treasury General Account, Bank of Japan, and People's Bank of China liquidity entering the market, and that's helped to offset some of the pressures of QT, but those effects, forgive the phrasing here, are transitory. And this time, it's actually transitory. So that abundance of liquidity that was in the market is likely to exit and bring stock prices lower, particularly as the Treasury eventually, we pass the debt ceiling higher, and the Treasury has to issue new debt. That's going to pull even more liquidity out of the market. It will amplify QT, and that's likely to be happening in the coming months. So just be careful with the assumptions that the worst is behind us. Of course, I'd like nothing more than for that to be the case, but quite frankly, I'd like to see more reasonable valuations, because buying here means future returns are likely to be very subdued and have much greater risk of downside. And I want to leave this with a funny comic. This is something I made. I've been making more memes lately for fun. How do we lower inflation? The boss asks. And this is not meant to be the Fed or the government. It's just theoretical, right? Just a chamber of people talking about how do we lower inflation. The first responds, we raise rates. It sounds good on paper, right? We're doing it now. It's having some positive and negative effects. The second one says crush demand, right? Because that is part of the equation here, the demand side. And then the gentleman on the right asks, boost supply? And the boss stares at him angrily. He stares back blankly and is, of course, thrown out the window because we can't have logical solutions. We have a supply-demand imbalance. There's a role for business and government to play in harmony to try to correct for that, whether it's in labor, agriculture, metals, energy, etc. There is a role that both business and government have to play there. They're not, and so we're setting ourselves up for a future economic cycle of structural inflation happening earlier on, causing central banks to have to intervene earlier, causing a more shallow bull market, a shorter bull market. And I don't want to say that's what's going to happen because that's what I want to happen. I'm saying that's maybe what we're set up for because none of the issues that brought us here in the first place are being resolved any more than on a short-term basis. So I want to thank you for watching this episode of Mayhem in the Markets. Be sure to check out macrovisor.com where you can check out more of my research and analysis. We have a 50% off your first year launch sale for our premium plans running right now. So check that out. It expires on April 20th. And also visit TraderAid.com. You can learn more about short to intermediate term trading. You get 20% off on me using the code Mayhem20. And on the base plan, you can get your first 10 days for free as a free trial. Or if you sign up for our Discord server, which is part of the TraderAid Plus offering, you get 24-hour a day as the markets are opening, bookmap streams that show you what's going on in the liquidity of the market. That in and of itself is worth more than the Discord plan sells for. And then we have a whole community. We have educational events. We have a lot of information that we're giving out during the day. So definitely check that out. And follow me on Twitter, Mayhem for Markets. That's Mayhem #4 Markets. And finally, be sure to like, subscribe, and share this video with your friends, your family, your associates, your trading buddies, your investing circle. Just get it out there. Help me to grow this if you enjoyed this content so that other people can enjoy it too. And I will see you next time.